Entity structuring for tax efficiency, it's what is designed to do. So many of you think just having an entity is only about asset and liability protection of a certain asset, a company, a piece of real estate, gas and oil, franchise, a laundromat, whatever you own. It is not just that. There's a tax efficiency because when your company makes money, it can activate the greatest tax code ever. It's what they're designed to do. The question is, are you set up properly? So we're going to talk about first is what entity and why entity structuring is such a vital part of what your tax bill is going to be. And your tax bill, how much you pay per year, it's prescriptive. If you really paid attention and leaned in and learned, you could get your tax bill under 10%. You could get it as low as you really want, but it does take more paperwork. It takes more strategy, takes more time. So money's time. I'd rather not overpay tax. I'd rather go put it back in my asset column and reinvest it into a new asset than overpay the government because you're slack in your behavior. And that starts with how you spend your money, how you do your bookkeeping, and who you use it as a tax strategist. And you are not a tax strategist. So stop doing your own taxes. We're also going to talk about the most powerful entity combinations that wealthy people have. And lastly, how do you know when it's time to restructure, reset a foundation, and at what levels? So let's begin. Entity structuring for tax efficiency means a combination of different entities. In America, you'd get an LLC, a limited partnership, an S Corp, or a C Corp. When those work together in a very strategic way through management contracts, officer and director benefits, you can actually prescribe a lower tax basis, which means you don't pay as much in tax. And here's a formula for a lot of you who think this is so casual and not a conversation that applies to you. It drives me crazy when people call in. It's okay, I paid $80,000. It's just part of being in the society and contribution. Well, what if you paid $80,000 over and over and over for 20 years? You're at $1.6 million you paid to the IRS versus pay attention, lean in and understand this enough, get the right team. So what I want to do is give you my Millionaire Maker book. I want you to fill out the gap analysis, which is up to page Chapter 3. You're going to read up to Chapter 3, do the gap analysis, where you are, what you want, where we're going to help you reverse engineer entire foundation as you join into the big table. And then I have tax teams. I just brought on a huge, awesome new tax team. So we have more and more resources for you to actually do these calculations. So if you think about the entities, number one, the biggest mistake a lot of you make is you stay a sole proprietor way too long because you bought the whole lie, total lie, that you can't control your taxes. You can control your taxes. And then the bigger lie is that some CPA or somebody or this internet machine called the bathroom wall told you that if you don't make $100,000, you can't really get an entity, an S Corp, a C Corp, a limited liability company or limited partnership. And that is not true. You can have any of those at 18 years old. You're a legal adult. So the way we set tax structure and entity structure to be affected by tax efficiency is we set it on intention. What is it that you want? What's the value you want to create? What's the kind of businesses you're going to create? Because as a business owner, you're going to have more money here to then go buy new assets. So as you make money, as you invest money, you start very strategically quarterly in our strategy, start looking at your taxes and what you do, what you can write off, what you can't write off. And then we get more and more strategic. S Corp is typically one of the entities that we use, depends on your state. Our tax teams will let you know which kind of company you need for the business you have. Usually LLCs are used for investment vehicles and the C Corp is used for management contracts. And that is the big one because it doesn't file tax on 12/31. It files tax at a different time of year, which allows you to have a cross and a multiple year tax end. That is vital to your success. So the combinations that wealthy people use is a combination of typically an S Corp and an LLC until they reach around $250,000, $500,000 in revenues. Once those companies reach that, you add a C Corp. We put it here in Nevada because of the history of having that Nevada asset protection, which is so profound. So a tax person puts it together, then our teams put the companies together, and then we reset you from bank accounts, credit cards, how you use them, like who pays for the phone, who pays for your vehicle, who pays for your wardrobe, who pays for your kids, which one is going to own the 401k. All of this gets reset that as you join into our big table. And then from there, it's how you're going to make more money and how you're going to invest more money. And you play in those two categories, and which is what wealthy people do. We're always looking for business opportunities and looking for investment opportunities. So while you're here, I want you to subscribe to the channel. We're here 5 days a week. Click that notification button, invite your family, grab the 2 tickets in the show notes to come to our Millionaire Intensive to truly have you understand what corporate life could be for you and your family. Now, even if you are both military, you're both employed, doesn't matter. Your family needs an operating company to activate the tax code. You're never going to go on a business trip if you don't have a business. So let's make one up. And you all have a ton of skills. When you read my Cash Machine book, actually in here we have over 1,000 different business ideas, and we have a brand new tool. I'm actually introduce it for the first time here. It is called the Cash Machine Quick Start. It helps you go through technically using some AI. What are you interested in? How have you made money? And it's going to spit back out to you 6 to 8 different ideas on what you can do for an operating company like that. So that's in the show notes. We're just announcing it's the first time we've ever released that. So when you have to look to restructure, a lot of people like live in one structure for a long time. I would say every $250,000 of new income, you need to be adding some new entity, because when you have one entity making millions and you don't have that management offset, or you're not using your entity to fund other entities for investments, your strategy is not tight enough. You need to be meeting with your tax teams, minimum quarterly, ideally monthly. And when you really start jamming and making millions, you're going to meet with your tax teams weekly, because every move you make has a taxable event. So lean in, pay attention, and make your tax efficiency as intense and fabulous as it can. It can get below 10%. You really can do that legally, but you have to actually care and want that to be a goal for you and your financial future. If you have any questions, go to askloral.com, ASKLORAL, ask a question, make a request. We'll be back tomorrow.